This is the All-Star Charts podcast with JC Peretz.
Hey guys, this week on the podcast, we have a very special episode. JC sits down with Jim Bianco to talk everything DeFi, or as they say, Decentralized Finance. Jim Bianco is historically a macro guy from Chicago with some of the largest institutional clients in the world, and he thinks DeFi is here to stay. In this conversation, Jim and JC talk about how any investor, young or old, professional or retail, advisor or client, can take advantage of this DeFi revolution. Technical analysis is the study of the behavior of the markets and market participants. And this conversation is most certainly all of that. I hope you enjoy.
I'm really happy that you're doing this. I wanted to pick your brain. I mean, a guy like yourself, you know, you definitely been an inspiration to me over the years. Certainly, we can get into that for sure. When I see someone like you, macro, institutional clients, a lot of interest rate conversation, whenever you and I are chatting, can't help ourselves but talk rates. And now all of a sudden, maybe not all of a sudden, but over the last few years, DeFi, I love it. I love it. I hate that I agree so much with you. I wish we disagreed. That's a lot more fun. But I want to hear from you, Jim. What's up? What are you looking at?
You want to start with DeFi? You want to start with the traditional financial world? You tell me.
Well, I have a funny suspicion that the conversation is ultimately going to make its way there. If I know you and me pretty well by now. So why don't you dive right in? Tell me what happened. Like, all right, so you're looking at interest rates. You know, you're arguing with somebody about the Federal Reserve, making your points, and then all of a sudden, it just hit you. This ain't working. There's something better.
It wasn't quite like that. It was, you know, you're right. I'm doing the traditional DeFi thing. I'm talking about the Fed. I'm looking at interest rates, complaining that gold isn't breaking out, you know, the whole 9 yards, you know, where's the stock market going to go? But in 2017, I opened up my first crypto account. I started punting in Bitcoin, and then I started punting in Ethereum, and it was fun, you know, kind of like Vegas is fun at the crap table, fun, but I didn't see any larger point to it. But then starting around late 19, early 20, I did one thing that was seminal. I used to keep my money like on a regulated exchange, like Coinbase or Binance. And then I moved it off the exchange onto a digital wallet. Metamask, to be exact, it's the most popular of the wallets, but there's plenty of good ones. And then I started to learn about DeFi, Decentralized Finance. And then I went and I looked at Compound and Balancer, which are lending and borrowing protocols. These are basically digital banks that are on the DeFi universe. And I went and I looked at some of the DEXs like Uniswap and SushiSwap, and these are decentralized exchanges is what these are. I went and I looked at Yearn Finance, which is essentially a digital hedge fund. As a matter of fact, there was a firm, Maple Leaf Capital, that actually compared Yearn Finance to Renaissance Technology and said it's a computer version of what Rentech does as well too. I went to Nexus Mutual, and I saw that there was a whole insurance protocol. Now, let me back up. Lending and borrowing what? You can actually go to these digital banks and you can, what they call, stake your Bitcoin or your Ethereum, and they'll pay you an interest rate back for you lending them your coins. And if I want to, on the other side, I could go and I could borrow coins and leverage positions in the DeFi, in the crypto universe. Because that's what you need in Dogecoin. Is it's not volatile enough. You need leverage on top of it as well too.
Naturally.
Yeah, exactly. So I realized I had my holy shit moment. This is a whole new financial system that is being created. Now, let's be clear here. It's raw. It's version 1.0. It's raw. It's got flaws. It's not ready for prime time. I could never get my mother to do this. It's too much for her right now. Look, traditional banking is almost too much for her right now as it is anyway. But if you look past that and you say, yeah, I get it, the user experience is not good, that you're subject to hacks, you're subject to bad programming, you can make a mistake, you can literally make a mistake and lose your money. But if you just say, yeah, that'll get solved over time, this is a new financial system that is banks without banks, trading without exchanges, insurance without insurance companies. It's cheaper, it's more efficient, or it will be cheaper, and it will be more efficient. And the traditional CeFi world, or centralized finance world, as they call it, to contrast it with DeFi, is going to have a very difficult time competing to it. And that was kind of where my evolution came with this stuff.
When you have conversations with traditional clients of yours, buy side, sell side, whoever your, people you're used to talking to, I'm sure you've had clients that you've had for decades and you've had conversations. When you're now having these conversations, talk to me about the reaction.
First reaction is it's going to get banned. It's going to get regulated. The ubiquitous they won't allow it.
Who's they? Government?
Yeah, government, large banks, Charlie Munger, because you saw what he said, that he called it disgusting over the weekend as well, too. Let's break that down.
If I were that wrong for that long, I'd feel disgusting, too.
Yeah. As they say, only Buffett and Munger can make that mistake, underperform for 25 years. You and I would never be allowed 25 years of underperformance as well, but I digress. Let's talk about what they mean by this. If you're saying that this is a superior technology, or to be clear, it can be a superior technology when it gets fully evolved, and therefore there are powerful interests in the regulation community and in the banking community that stand to lose, so they'll use their muscle to prevent it, that won't work in the long run. I've used the analogy of, early on, there were mayors in various cities, including my city here in Chicago early on, that said no to Uber, that, you can't do this Uber thing. They had a vested interest in keeping the taxi cabs coming, so you get to go in that yellow, smelly, cappy yellow taxi. And eventually people just started to demand the better alternative, and it became unstoppable. So if that's why you're doing it, because you're admitting it's better and you can't compete with it, so you're trying to put up a moat, that won't work in the long run. The second thing I point out to people is this is peer-to-peer technology. Now, you may remember peer-to-peer technology from Napster, because they kind of popularized it 20 years ago. It's my computer connecting with your computer and sending a file peer-to-peer. This same thing here as well. Why is that important to note? There is no central server. There is no Amazon Web Services. So go to Amazon like they did with Parler and just tell them to turn it off. You can't turn it off. There is no off switch with a lot of this stuff. You can regulate the on-ramps. You could tell Coinbase and Gemini, here's 10,000 rules you have to adhere to. You could do that, but then there'll be other ways that I could get my money out of a Citibank and into the crypto universe as opposed to a Coinbase as well too. But once you're in this universe, very little regulators can do to actually stop it. And then finally, there was a survey put out earlier this year by Statistica, and they asked at least 1,000 people in a bunch of different countries, have you used, or have you owned, or do you currently own cryptocurrency? Country that came in with the highest percentage was Nigeria at 32%. Venezuela was up near the highest of the list. Iraq was near the highest of the list as well too. A lot of third world countries, a lot of African countries, in the case of Nigeria, were at the top of the list. What was near the bottom of the list? Germany, France, United States, and Japan. The rest of the world is looking for an alternative to the current centralized financial system, especially in the third world, because they don't think it's a good deal for them. So they're willing and they are moving on this. This is why Turkey posed a ban on this stuff a couple of weeks ago. And the Turkeys, give them an A for honesty. They said, we are going to ban the payments of cryptos. You could still own it because they can't stop that, but they won't allow you to use it as a payment mechanism. And they said, because it's sucking money out of the Turkish lira, it's falling in value. Okay, you admitted you have a crappy currency and this is a better alternative. So you're just, instead of fixing your currency, you're just going to basically regulate the competition is what you're going to do. My point is that's how big it's gotten in Turkey. So if we want to ban it here in the U.S., then they'll all create the financial system of the future without us.
Yeah.
So that's why I think, yes, regulators have the capability of making it very, very difficult. They could scare a lot of people away from it, but they can't do away with it permanently because the rest of the world is adopting it much faster than we are.
So let's say Mr. Smith, buy-side PM, that you're telling this to says, all right, Jim, I've known you for a while. I'll give you this one. Let's say you're right. Now what? What am I supposed to do about it?
I think what you should do is you should engage in an education fee. And what I mean by an education fee is take $300 or $500. Or if you're Mr. Buy-Side PM, take $1,000. You can afford it. Open a Coinbase account, buy some Ethereum, move it to a digital wallet, try and lend it to earn an interest rate. Now, I want you to do that not because I'm telling you a great investment idea, because I want you to learn this system. Because this is the future, and it's going to be difficult to learn. Let me put it to you this way. When we were undergrads in college, you had to take a full year degree to get a degree in finance. And then most of the companies wouldn't hire you until you went 2 more years and you got an MBA. There was a lot to the financial system. This wasn't, it wasn't when I was in college or you were in college. Yeah, we'll take this 3-day course called What is Finance? And then when you're done, you can send your resume to Goldman Sachs because you've got it all figured out. This is the same thing here. This is going to take years to understand. This is going to take a long time to get your head around. This is going to be like you're 19 years old and starting all over again with a new financial system, new terminology, new ways of doing things. So get started on that process of learning this. And then along the way, as you get enlightened, you can make your own decision as to whether or not you think this is a viable investment as it currently stands, or maybe you'll think eventually it will be, or maybe you'll come to a conclusion that it's not. But at least you have made the effort to understand it.
I was talking with a gentleman by the name of Patrick Dunawilla. He's the editor of the Chart Report. I don't know if you receive it. Definitely get it. It's free. It's awesome. And the way he put it was the biggest risk is to not learn the stuff. That's the risk. The risk isn't to be in it. The risk is to ignore it. Would you agree with? I thought that was well said.
I agree. And let me give you an example because there's some really mind-blowing stuff that could be coming down the road that could really upend everything. There's 9,400 coins and tokens on the big website CoinGecko, which is one of the popular websites that track this stuff. 9,400.
It's crazy.
Are you kidding me? I thought there was Bitcoin, Ethereum, and Doge. Well, what's happened is that people are starting to learn that there's a whole new economics coming in. It's called tokenomics. And so let me give you one example, my favorite 2 examples. Example 1, there's a browser called the Brave browser. And they have a token called the Brave Attention Token. And what they do is they pay you to watch ads. Now, how does that work? Well, currently, how does it work? Currently, big companies, say Ford or GM, gives YouTube a ton of money, and YouTube then plasters Ford and GM ads all over the YouTube. So if you go to anything related to cars, you got to sit through a Ford or a GM ad. And then depending on how many views they had that month, they send Ford and GM a bill, and YouTube gets paid. You don't get paid for watching the ads. They get paid for serving them to you. Well, Brave wants to set this up where you go on Brave, and you say to Brave, okay, here's what I'm interested in, and I will allow ads of what I'm interested in on my browser. And as those ads come on your browser, you get paid to watch them, not from Brave, but directly from these companies. Now, how do they pay you? Brave has a token, the Brave Attention Token. Every time I watch an ad, I get a fraction of a penny. I watch hundreds of ads a month, month after month. It adds up to some real money. The Brave Attention Token trades on a bunch of exchanges. It trades on a bunch of decentralized exchanges. I could take my Brave Attention Token, I could convert it into Bitcoin, or if in the future some retailer will accept it, I can buy stuff with it as well too. How does Ford and GM work with this? They go out on these exchanges and they buy Brave Attention Tokens, and then they feed them into the people that watch their ads. So we've completely changed the economics of advertising. Another example is there's some sports tokens. A lot of the European football teams, Juventus and AC Milan, are doing this right now. As a fan, you buy a sports token. It gives you certain discounts to buy, merchandise and maybe tickets or deals on tickets as well too. But you also get some ownership rights. When the team plays a friendly, you get to use your token. If I have one token, I get one vote. If I have 100, I get 100 votes to vote the starting lineup. It keeps the fans. It keeps the fans interested. It keeps the fans engaged. Then Juventus or AC Milan can create these tokens, feed them into the fan universe, and get paid back in cryptos the other way. So it changes the economics of a lot of things. Is where this goes. There's been some arguments that in the future you will have stocks and bonds and tokens as part of the capital structure of a corporation. So for you, JC, we're going to give you thousands of other trading options, right? You're going to have bonds, you're going to have stocks, you're going to have commodities, currencies, and hundreds and hundreds and hundreds of tokens that are going to be associated with companies as well too. So the whole capital structure could be changed. And I might add, if this works the way everybody thinks, and I'll use the fancy word, it's going to generate a lot of alpha. Because what is the big complaint we have right now? At the end of the day, we could talk about trading stocks, we could talk about our ideas about stocks, or you could just buy spiders and just beat everybody by doing one simple trade for no commission on Robinhood. And it's so hard to beat it because it's so hard to find alpha in this world. But in this token world, there's going to be tons of alpha to find. Boy, get ideas right, and they're going to zoom off the page. Get ideas wrong, and your shorts are going to collapse. And, you're going to way outperform or way underperform a benchmark, depending on if you get it right or wrong. Because currently today, the benchmark goes up 12%. If you do bad, you're up 11. And if you do good, you're up 13. So that can change a lot too. So that's why I think I agree. The mistake would be to sit this out. And why start now? Because we're in that curve, that learning curve right now. Get in, understand it, and know that things are going to change. Look, I'll make a crazy statement. This could be as big as the internet itself, because we're going to change the basic structure of finance, is what we're going to do if this works out. There is a chance that it might not. There is a chance that it could wind up being a mess. I don't think it will be, but if it works out, it can be very big.
Let's rewind a little bit. I know some of these answers, but I want to hear it from you, and maybe you'll have some different thoughts than what I have in my head. Okay, so you got your Coinbase account, you got your Ether, a little Doge, some Bitcoin, whatever it is you've got in your well, you can't get the Doge in Coinbase. Whatever you got in your base,
you could get it on Robinhood.
You can get it on Robinhood. That's the funny part of the whole thing. Yeah. So now you got your Ether in your Coinbase account. You open up a MetaMask wallet. You move over some Ether. Okay. So now what? So how does the yield work? How does the lending work? Walk us through that, especially someone like yourself. I feel like every time I hear you, you're talking about rates and bonds. I mean, this is like right up your alley. So talk to me about how the yield farming works.
Okay, so you move to a MetaMask wallet. And by the way, let me plug somebody. There's a guy on YouTube, Crypto Dad, CRYPTODAD. He does a whole series of videos that are how to open a Coinbase account, how to buy Ethereum, how to transfer to your Metamask wallet. And the video is just him and his screen. And you could click here and paste this here and hit OK here. And that's the way I learned it. I had it on my iPad, and I just did what he did, and that's how I learned.
That's a great name. Crypto Dad is fantastic.
Yeah, he's an older guy. He's nearly, he's in his 50s or something like that, and so you wouldn't associate him. He's not a millennial or Gen X. Or Gen X.
Crypto Dad. It's perfect.
Yeah. And his kids sometimes run in the middle of the video and stuff like that. So, but he offers no advice. He's not saying you should buy Ethereum, but if you want to, here's how you do it. You shouldn't move your money to, I'm not telling you should or shouldn't move your money to MetaMask, but if you wanted to, here's where you do it. So there's my one plug. If you wanted to learn how do I do this, watch him. Okay, so now you're on MetaMask. You go to Uniswap. Uniswap is the largest decentralized or DEX exchange on the Ethereum network. And you go to uniswap.io. It's a website. .io for input-output. And when you do that, it will recognize, if you have your Metamask wallet open, it will recognize your Metamask wallet and ask you and connect you to the site. Okay, I see you have a wallet. I see you have some coins in your wallet, and now you're connected to the site. It's a trading site. You can then go and you can find, remember, it's a currency, so you find the pair that you want to trade. So let's say you have some Ethereum in your wallet, and let's say you want to go buy some Doge. You would go find the Ethereum Doge pair, and you would exchange your Ethereum for Doge, is the way that you would do that. And so it allows me to buy and sell thousands of different currencies. And by the way, this is not done with order makers. This is not done with bids and offers. There are no bids and offers. This is done with liquidity pools. What is a liquidity pool? It's a new concept. And so that Doge Ethereum pool, they would also say on their site that you can stake your coins. So if I have some Doge or Ethereum and I want to own it and I don't want to trade it, I can give it to this pool. And then when I give it to the pool, every time somebody does a trade in the pool, 0.3 of 1% is what the commission is currently. They want to maybe push it down. Part of that commission goes to me, the staker. Part of that commission goes to Uniswap to continue to fund Uniswap as well too. And it's all written into the software, the smart contract, as they call it. So if I did it with $5, if I did it $500 million, it's exactly the same percentage. It doesn't matter what the size is that you do it. And so if you stake your coin, that's how you receive interest. And in some of these pools, you can receive quite a bit of interest. By the way, how does the trading work? There's Doge and there's Ethereum in the pool.
Yeah.
Now let's say I want to buy Doge. I would then go to the pool and I would add my Ethereum into the pool, take Doge out of the pool, and the pool will always rebalance the price so that it's equal value of Ethereum and Doge. So if I'm putting Ethereum in, I'm increasing the supply, the Ethereum price would go down. Taking Doge out, that price would theoretically go up. And then there's a whole set of arbitrageurs that will arbitrage that pool to Coinbase's price or to Binance's price as well too. But on the Uniswap network, they do 2 million trades a day. 2 million trades a day. They have tens of billions of dollars in their staking pools as well too. So that's how you wind up getting interest. Where do they get the money for the pools? I lend them my coins. They pay me a cut of it. There's no exchange that takes out of the middle there, and so that you get the cut of it as well too. Same thing with a lending pool. I could go to a lending pool and I could say I've got some Ethereum. I could give them my Ethereum, and then they'll lend it out to somebody else, and then that somebody else will pay interest. By the way, the interest is paid in more coins, is what it is that you get more of the coin.
Naturally.
Yeah, exactly. Because there's no fiat in this world. You can't bring U.S. dollars into this.
Big no.
Yeah, and so that's how this stuff works. And it's most effective in what's called a stable coin. Tether is a stable coin. USDC is a stable coin. A stable coin is a coin that has its price fixed to another asset, usually the dollar, at 1-to-1. And the reason that stable coins are so popular is, remember I gave you the example of Ethereum versus Doge? Well, one's a very volatile currency, the other's a very volatile currency, and now I'm looking at the cross rate between two very volatile currencies. It's all over the place. So to make it easier, I'll do a tether, which is fixed 1-to-1 to the dollar. So I got one stable end against the volatile end. And so what's happened in the cryptocurrency space is the majority of cryptocurrencies that trade every day are a stable coin. Because if you're buying Ethereum, you're not buying it with dollars. You have to buy it with another coin. If you're buying Bitcoin, you have to buy it with another crypto. And most of those transactions, 2/3 to 3/4 of them, that other crypto you're buying it with is a stable coin, because it makes it a lot simpler and a lot easier. Because otherwise you're trying to price it out and, oh, Dogecoin just moved, and oh, Ethereum just moved, and oh, Dogecoin just moved. And you're watching this thing go up and down like wild, and you're trying to set a stop, and it's impossible. No. So that's why it makes more sense to use a stable coin. So you can actually stake your stable coins as well too on a lot of these pools. They're actually the most popular thing to stake, because every pool, just about every pool, has a stable coin as one of its legs. Hopefully I didn't talk over everybody here, to kind of give them an idea. And hopefully the message I'm leaving you with is, yeah, there's like a whole financial system being built out there in parallel to the one that we use today.
All right, let's bring it back to price. It's funny. I guess over the years I've been known for, when I give my presentations, I just rip through a zillion charts. And I was at your office a few years back. We had some lunch, and then you're like, hey, DC, you want to look at some charts? And I'm like, yeah, obviously. So you go by your desk and you start just ripping through charts. I'm like, oh my God, that's where I got that from. That's why I do that, because I saw you give a presentation like almost 20 years ago probably, and you just ripped through a zillion charts, and that influenced me. That's how I give my presentations, and it hit me when I was in your office. I'm like, oh my God, this is where I got that from. So anyway, the point is, you obviously look at a lot of charts. You're looking at these Bitcoin charts, the Ethereum charts. You're seeing these big base breakouts, just classic technical analysis, classic market behavior. I personally have never seen any asset class that trades as cleanly as these cryptocurrencies. Maybe gold was the cleanest one, but man, these are just off the charts, no pun intended. Just clean charts. Would you agree? What are your thoughts there?
I think that this is going to save technical analysis if it needed to be saved. It is because so many of these people are into technical analysis that if you dig deep into the trading aspect of the coins, we were talking about the finance, but let's talk about the trading aspect of the coin. These guys are on Twitter, they're on Reddit, and they're talking about support and resistance and Fibonacci retracements and Elliott wave, the whole pennants and pennants and channels. This is like taking the CFA exam, is what it is, and they're doing this on extraordinarily volatile instruments as well too. So it is kind of interesting because just 10 days ago, Bitcoin had a 20% correction from its all-time high, which was 10 days earlier. And these guys are like, yeah, but it's only 50% correction in the last move. Yeah, but in the stock market, if it fell 20% in 10 days, if the S&P went down 20% in 10 days, we would collectively be shitting our pants over that. But that happens about once every 6 weeks in this space. And so technical analysis is a major driver of this stuff. And what really tends to be their movements is congestion breakout. These things congest, and everybody talks about where resistance is. And because of the network effects on Reddit and on Twitter, if 1,000 guys say, if Dogecoin breaks, 49 cents, that's resistance, it's broken resistance, it goes 48.5, 49, then it goes 49.1, than 55, 60, 66, like in 5 minutes, because everybody thinks it's broken resistance because everybody's a technical analyst in this space. It's hard to put fundamentals on it, so technicals really drives it.
Yeah, what fundamentals? There's no earnings. There's no cash flow. Like what? What fundamentals?
Yeah, exactly. So if you are a technical analyst, you are in nirvana when you're in this space here. It's just so much fun.
All right, and listen, I'm not going to hold you to it because, listen, you don't know what's going to happen next. I don't know what's going to happen next. The good news is nobody else does either, right? Now, with that being said, for all the crazies out there that take everything we say so literally, just, pretend no one's listening. You and me hanging out, drinking a couple of beers at the bar in Chicago, and I'm asking you, I'm like, yo, Bianco, how high do you think these cryptos can go? Right? What would you tell me?
I think, first of all, I think Ethereum is going to flip Bitcoin. And what I mean by that, Bitcoin's got about $1.1 trillion market cap. Ethereum's about $400 billion. I think eventually Ethereum is going to be larger than Bitcoin eventually.
Well, I'll stop you right there because, I mean, you just nailed my favorite chart, which is a massive base in the Ethereum Bitcoin chart, right?
Right.
Massive base. I mean, just classic, right?
Right, exactly. And it's breaking out, and I think it's going to go, and it's going to go big. Now, if Bitcoin doesn't move, that puts Ethereum at around $9,000 from $3,500 right now. And again, that's over the long, let's talk about over the long term. The other thing,
what's long term in this market?
2 to 5 years.
That's funny that you are talking about 2 years as long term. That's hilarious in and of itself. All right, go.
Right. I mean, no, that's secular in this market. Yeah, that's like Warren Buffett's career.
Right.
So what I'm trying to say is, I think the long-term trends are higher for a lot of this stuff. Now, as I said that, because it's highly speculative, let's look backwards and let's look at Bitcoin because it's the oldest one. It's been around since 2009. It has had 7 corrections of 80% or more, and the 2018-19 correction was 93%. It lost 93% of its value, and it eventually made new highs, as it has already to 60,000. I do think there'll be another 80% correction in this thing. And when I talk to a lot of the trader types that I talk to in this space, oh yeah, absolutely, there'll be another 80% correction. But does it start at 6,000 and we go back under 10? Or do we run to 250 first and then the 80% correction gets us back to 50? That's really, but understand what I'm trying to say here is that there's going to be an 80% correction. There always is. Hey, there was in Amazon, there was in Apple. If you go back and look in the 80s and 90s, when these things were brand new technologies, they were all over the lot as well too.
Oh yeah.
And if you look at the Plug Powers and the Neos today, they're all over the place. Or whatever ARK is buying this week is all over the place as well too. So that's part and parcel of this. So let's not delude ourselves that there can be vicious corrections. And like I said, 10 days ago, there was a 20% correction. And in March, there was a 25% correction in these. So there's going to be a lot of volatility as we move along. Now, short term, boy, oh boy, ETH has had a giant move. And it seems to be consolidating for the moment around 3,500. There's been a bunch of news that has been come out on it. So it's been a lot of sell the rumor or buy the rumor, and maybe it is sell the news for this. So I wouldn't be surprised if we start to see it slow down a little bit. And as far as Bitcoin goes, if you look at the top 8 not stable coin coins in the world, so forget the tethers and stuff that are in the top 8. Bitcoin has returned you 100% this year, and it's the worst performer of all of them. And to that point, it's actually done very little since February.
Yeah.
I do think that there has been a massive, when you talk about the ETH-BCT ratio, there is a rotation out of it and into some of these other coins, whether it is Doge or whether it is Filecoin or whether it is Solana or some of these other coins that are getting ADA, Cardano is getting some attention. Uniswap has a currency, the Uni token that's getting a lot of attention as well too. So there's been a lot of movement in Binance Coin. The Binance Coin has been moving as well too. So I do think that away from that, there is more of a distribution away from the big dog of Bitcoin into everything else. If I was to give you a reason for it, I think people are starting to realize, yeah, Bitcoin's cool, but boy, you can do a lot more with Ethereum.
Right.
And that's why everybody's jumping on the Ethereum bandwagon. That's not to say Bitcoin is not useless. It is the store of value. It is the digital gold of this space. Gold is important in the CeFi world, and Bitcoin will always be important in this world as well too. So longer term up, next couple of years. Shorter term, be prepared if there's at any moment, what do you do if there's an 80% correction? I mean, I know what you do. You stop looking at your account and wish you never did this stuff, right? But you have to be prepared that if you really think we're going to go to 9,000, maybe we go to 1,000 first on our way to 9,000. And I knew a lot of people in 2018, Ethereum hit 1,400. And I'm thinking of two people in mind. I won't name them. But boy, when Ethereum was back under $200 after hitting 1,400, they were hoovering it up. Man, wave them in. And boy, it has been a tremendous payday for them now that it's back at 3,500 or so. So if you can have that kind of fortitude, yeah, I really like Ethereum at 3,500. And then next thing you know, is it's 995. Oh, great. Then I could buy 3 times as much for the eventual move to 9,000. That's easy to say, JC, as well as I do. That's easy to say now, but once you've lost 2/3 of your money, you don't open your account and look at it anymore. You try to pretend that never happened, and you disavow any ownership of this, and you feel kind of stupid and everything else. And then it's only when it's got the upward momentum do you get really excited about this stuff.
Classic human behavior, Yeah. It's no different in the stock market, right? It's the same thing in the stock market. And it's funny, what you're describing is money coming out of Bitcoin, rotating into some of the others. Classic sector rotation, right? Is that what's happening here?
Exactly. Oh, that's exactly what's happening. And what's also happening too is because of all that borrowing and lending that goes on in these currency pairs that they're trading, the intra-correlations between these coins is going up as well too. So if I'm looking at my board and I see that, Bitcoin and Ethereum are having a huge update, most of the coins are having a huge update. Bitcoin and Ethereum are getting smashed. Most of the coins are getting smashed. It's no different than the NASDAQ and the S&P are up today. Well, I don't have to go look up Apple. I could probably guess what it's doing. If it's a big up day in the NASDAQ and the S&P, or it's a big down day in the NASDAQ or the S&P, kind of the same kind of thing is happening in this space as well, too.
You mentioned a bunch of the crashes. I think you said 7 crashes of over 80% or something like that in Bitcoin that's been around for a little over a decade, which is hilarious in and of itself. That sort of market behavior reminds me of the 1800s, the early days of the stock market, when every other year was a panic. It was like the panic of 1876, right? The panic of this. Every other year was a panic. Is there something to the fact that when markets are in their infancy stages, the cycles happen quicker? Is there something there?
Yeah, the panics, the 1871 panic, 1873 crash,
right.
1869 there was a crash.
Right.
1893 was a panic as well too. Same thing. What was going on in the late 19th century was we were creating new technologies. Back then it was the telegraph, and it was the steam engine, and it was the transcontinental railroad.
Yeah.
And people were watching this stuff get built. They could see, boy, this is going to be a big deal someday. And they weren't sure that it was going to play out, or that they had the right idea, or they had the right protocol. Let me give you the example that I've used in the crypto space. I believe that this space is going to become huge, but here's my problem. I'm going to use the example of e-commerce in the late 90s. I think e-commerce is going to be the biggest thing going. It's 1999, and I think e-commerce is going to be it. And you'd say, in 2021, yeah, Jim, you're 1,000% correct. Yeah, but here's the problem. In 99, I decided that the way I was going to play it was Amazon and Pets.com.
Right.
By 2001, Pets.com went to zero. It went out of business. Amazon, a lot of people don't know this, went from $100.99 to $6 in 2001. I would have lost 100% of my money in one and 94% of my money in the other. And I would have pretended like, oh, that was the stupidest idea. And then Amazon goes from 6 to 3,300.
Now you're a genius, then, right? Yeah, genius.
No, I would have bailed out long ago. So to use the example of Pets.com, I think this space is huge. But what I worry about is, am I buying the next Pets.com or am I buying the next Chewy? And I got to make sure that I'm in the Chewies of the world that succeed wildly, and I'm not in a bunch of Pets.com, or I got to make sure I'm not in Alta Vista or I'm not in Dogpile or Lycos, because those were all the early search engines that kind of went bust.
Right.
And I want to make sure that I own the Yahoos and the Googles of the world, which were the successful ones. And it was the same thing in the 19th century, right? We didn't have one railroad. We had hundreds of railroads.
Shit show.
And, and everybody knew railroad is going to be the biggest thing in the world. Yes. But there's hundreds of these.
Which one?
Which one? And that's why there was always these panics and booms and busts, because everybody was afraid I have the wrong railroad, or somebody else came up with another idea. Oh man, I got the wrong technology. They're talking about this internal combustion engine thing, and I'm talking about steam, and I got, and so they all panic and they all go back and forth. Or there's these telegraph wires, but somebody else has come up with a new telegraph wire that's even better, and I'm in the wrong one. And so that's why they boom and bust all over the place. We know the end game is going to be, we're going to have telegraph and we're going to have steam engines, but we don't know which one. Well, it's the same thing here. We know the end game, I think, is going to be decentralized finance, and we're going to have these tokens that are going to be proxies for money, but we don't know which ones. And that's where we really struggle with a lot of this stuff, to try and figure out which ones. And that's why early technologies just boom and bust all over the place.
I think one common misconception is, particularly from professionals, because I don't think the younger investors really give a damn about market cap. But for when you have a lot of institutional money, that's obviously, it's a big deal. When you look at the list of the market caps of these coins, I mean, these coins, in some cases, investors may have never even heard of them, and they're bigger than most companies on planet Earth. These are massive market caps.
Yes, and as a matter of fact, it's kind of funny. I tweeted this out this morning. Dogecoin, I'll be the first one to admit that Dogecoin has no use case. It's not really a thing.
Yet.
Well, there's no economic value to it. Look, if you want to invest in Dogecoin, it's no different than the craps tables at Vegas, or the Baccarat tables in Atlantic City. If you want to put $500 in your Robinhood account, you want to punt Dogecoin around and have some fun, and maybe you pull out a few $100s. I'll use the craps table. So look, you go to Vegas at $500, and you had a good night, and at the end of the day, you go home with $2,500. You made $2,000. Congratulations. Are you draining your 401k and IRA account the next day to go to the craps table? Absolutely not. Don't do that with Dogecoin. Be happy that you pulled a couple of $1,000 out of a $500 punt.
But why are you picking on the Doge? Because the others is not the craps table? Maybe a little more blackjack or poker?
Right. But so understand that's where my thinking is in Doge. But there was somebody who pointed up the problem and said, I can't believe Doge is worth $80 billion, which is what it's worth right now. It's worth more than some major corporations right now at $80 billion. And it's the third largest or fourth largest coin by market cap of all the 9,400 of them. It's Bitcoin, Ethereum, Binance Coin, Doge. And then somebody else commented on Twitter is like, well, maybe the answer is Dogecoin's not too high. It's everything else is too low. Is what the answer is in this space. So
good point. It's interesting.
We don't know. We don't know because it's a new space. Maybe what Doge is telling us is everything else should be far higher, as opposed to the Doge is way, way overdone. The other comment I'll make about Dogecoin, Metcalfe's law and network effects, that in 2021, because of social media, network effects are constantly underestimated. If you were to ask a millennial or a Gen Xer, how do you do marketing? The answer is you do networking, you do network effects, you create a buzz on social media, and you get everybody talking about it, and you get this giant network effect. That's what Doge is. It's a meme coin, and it's got this giant network effect. And I think the older generations have a hard time understanding how something could go from nothing to mass adoption in lightning speed because of social media. And I'll even turn the question to you, JC, because you've watched markets for a long time, and this is a question we've been asking. Look at what's happened in the traditional financial markets in the last 6 months. We had a mania in options. You know, that retail investors are buying options like mad. We had a mania in GameStop. We had a mania in the ARK stocks. And how do we usually think manias end? We usually think they end badly by blowing up. But these manias sort of ended where everybody got bored with them and moved on to the next one. I don't think I've ever seen that before. And that might be because what we don't appreciate is there's this network effect that you can go from nothing to the biggest thing in the world, GameStop, in like a week. And, you know, you drive the stock from $20 to $500 in 4 days, and you go, oh, this is going to end badly. No, because then somebody on Reddit's going to say, okay, now we're on to the next idea.
Well, it ended badly for the leveraged short funds.
Right. Well, it ended badly for a handful of people, but it didn't end badly for the whole market.
Right.
And then they just move on to the next idea, and they move on to the next idea. But usually what we worry about is that GameStop or Dogecoin is going to blow up, and all these people YOLO'd into this, and they lost their life savings, and they're going to go crying to the regulators, oh, I can't believe I can't send little Johnny to college now because I blew all my money in either GameStop or something else. But that does happen in isolated occurrences, but not in widespread occurrences. Or worse, that when it blows up, it takes the whole market with it. None of that happened this time. So I've never seen manias, if you can call what happened with options and GameStop and, you know, the ARK type of tech stocks and stuff like that, that they had these little mini manias where everybody went flying into them, but it didn't end in a disaster for everybody. Archeos, you know, it blew up and everybody said, oh, that's it. The over-leveraged hedge fund blew up and it was the only one and that was it. There was nothing else after that.
There's nothing systemic there.
Right. And what was everybody expecting when you first figured out how to pronounce that name? Was that there was going to be more shoes to drop.
Right.
It wasn't. There was only one shoe. And that's unusual, I think, because I remember long-term capital, and I remember, you know, that there was always these systemic events and this knock-on effect. But I think the difference is because of the social media network effect, you can go from nothing to 5 million people playing it, to the 5 million people get bored with it and move on to something else in like lightning speed. And that it isn't just, it takes a while to get everybody into it, and then everybody rides it right back down. So it's very, very different. I don't know. You have any thoughts on that?
For me, sort of less, you know, for me, the GameStop and the AMC, I mean, just classic short squeezes, been going on forever. So, you know, when I ever got asked about it, it's like, yeah, they got squeezed out. They had irresponsibly aggressive short positions, and the market punished them. That's the market doing its job by punishing irresponsible behavior. Classic, where it gets me.
Don't you admit, though, that the scale was unusual, the size of the short squeeze, to go from $2 to $20 in a week?
Yeah, but how is it any different than the natural gas guy who made the YouTube video crying because he was picking up pennies in front of the steamroller right a few years ago? How is it any different? I mean,
yeah, that's true. That's true.
You're being an idiot. You could be an idiot for a long time. This market will let you be an idiot for a while, but then one day you're going to wake up and it's over. It's over, right? So for me, I throw it in that bucket. For me, the bigger thing is, you mentioned all these crashes in Bitcoin and all the other ones. I feel like they've had every opportunity in the world to go away, and they haven't, right? They've had every chance in the world to go away, and no one's ever been able to finally, you know, put that final nail in the coffin. And not only are they still here, not only do they keep coming back, they're stronger than ever. That's what kind of gets me.
Yes, that won't kill you, makes you stronger. Yeah, you know, Paul Singer of Elliott Management, another, you know, old guy that hates cryptos, said, I can't wait for the day that I get to say I told you so. And somebody tweeted on Twitter, what again? You weren't around in 2018 when it corrected 93%.
Yeah.
You know, you could have said I told you so then, and then it went from 2,000 or 3,000 to 60,000 in the next 2 years right after that. So yeah, you'll get plenty of time to do this. But I agree with you. Every time something bounces back from an 80% correction, it's that much stronger, because now what do the people that play this space know? It could correct 80%. I said it myself. It could correct 80%. You should not panic if you see that happen. You should almost expect it. The only question you're really asking yourself is, from what peak does that 80%, next 80% correction start from? Like I said, maybe we were lucky and it goes to 250 first, and then you feel like a genius for a minute, and the next thing you know, you're 50,000. Or maybe it already peaked at 65, and eventually it's going to work its way back under 10. We don't know yet, but ultimately on the backside of that is probably 100,000. Going to 100,000 is not going to be easy. You're going to have to endure a lot of fortitude along the way.
Let's talk about systemic risk. You said that a couple of times. I've been in the camp since day one with these things that there is no systemic risk. All these cryptos can go to zero, and it's not going to play an impact in the global macro environment. You're not going to see real massive unwinds, long-term capital management type stuff. Are we starting to get there now? Like, is there now systemic risk on the table?
Not yet, but I agree with you. We're close. Like, if tomorrow, we awoke and the world just decided that every crypto was worth zero, I don't think there shouldn't be any impact on the economy, because what's happened is this system is still fairly closed. It's cryptos trading against cryptos. They're still trying to build, this is still the 1.0 beta version of what they're trying to build. We haven't dragged in GM, hey, use cryptos to finance your car production or something. We haven't done anything.
Well, a few companies are getting there.
Yeah, some are getting there. You can buy a Tesla with Bitcoin now, but that's just a handful of examples. As that continues, then it becomes more and more the potential of being a systemic problem. As banks start to get into this, it has the potential to be more of a systemic
So it's adoption, not market cap?
Yes, I think adoption is where you're going to wind up with systemic, because right now I was careful with my words, it's a parallel system, right? It's not part of the regular financial system. It's a parallel one, but eventually it gets integrated into the main system, and then you wind up with it having a systemic problem. Hopefully, by that point, you've had so many market cycles and you've tested the software and you've written it so that you've made it correct, so you don't get hacks or anything else that wind up blowing up the system, that when you bring it in, those types of things are not your problem. Your problem could be just, human mania, that we just went too far with this.
Well, that's definitely going to be a problem for everybody, I'm pretty sure.
Yeah, you can't program that out.
Right.
But what I don't want is to find out that some kid in Belarus figured out a backdoor in and blew up the whole system. Right. Hopefully, we've got that solved before we brought this system into place.
And how does this affect the other asset classes? How does it affect bonds, stocks? Does it affect it at all? I think we could agree it hasn't helped gold, but how much has it hurt it? Right? These are the questions I've got for you, on a more traditional side of market analysis. How do these things impact the other ones?
Well, let me start with the last one you asked, gold. It has definitely hurt gold, because really, let's look at what's going on in the commodity space.
They're all going up except gold.
I was going to say, which one is not going parabolic, right? I mean, lumber. I've been tweeting out the lumber chart, going, no, this is not a cryptocurrency. It's lumber. With the way that thing has been going straight up, they're all going straight up. And to me, getting into the traditional space, inflation's coming. It's coming in a big way. Now, maybe it's short-lived, but it's definitely coming if it's not here already. And this is what Peter Schiff has waited his whole life for, to watch gold go straight up. And instead, it's just sucking wind. It's like the only commodity that's really not doing anything right now. I think that's because it's got this digital competition in Bitcoin.
It was going down in the second half of last year while the dollar was falling. That's how bad gold is.
I know. Now, as far as how does it affect stocks and bonds, you've got a capital structure for a company, right? There's equity at the bottom, which is the owners of the company. First of all, you have senior. Let me start at the top. It's easier to explain it that way. You start with senior bonds. They get paid first. Junior bonds get paid second. You've got more and more stuff in the capital structure. Then you've got preferred stock, and then you got equity. And when everybody else gets paid, if you run a good company, there's lots left over for the equity holders, which is why equities go up a lot. Well, in this new world, you're going to have tokens in there too, is what you're going to have. You're going to have a more complicated financial structure, capital structure, excuse me. And that's why I said for the analyst and for the trader, that'll be good because it'll give you more opportunities to find ideas to exploit to make money. You'll have more things to look at to find, and it won't be just less correlated stuff. So it will, I think if it plays out the way I think it will, you'll start to see it being incorporated into the financial structures of these companies. As far as individual stocks and bonds go, we'll maybe transition some of this stuff, maybe a little less bonds and a little bit more tokens. I don't think we'll have a little bit less.
But what about companies going to coins versus issuing traditional bonds or something in that direction?
They should. There's a great example that was used that I heard. One of the things that Tesla has going for it is the average person who buys a Tesla. It's a $70,000+ electric car. If you're in the market for a $70,000+ electric car, guess what? You like Tesla, you probably also own the stock.
Yeah.
So the people that buy the product also own the stock as well too, and that symbiosis works to help send it up. Let's look at McDonald's. Chances are most of the people standing in line to buy a Happy Meal, they're not owners of the stock. So you've got the customers of McDonald's, which is a separate group than the equity holders of McDonald's. You bring a token in place, and you can merge that group. Buy the McDonald's token. It'll give you some kind of a stake in the company. Maybe it'll give you a discount on meals.
I was going to say a burger or something. Yeah.
Right, or give you some other benefits. And it's a digital token. You can buy $100 of it. You don't have to buy a lot of it. And if you can get the customers also being advocates for the ownership of the company via a token or the stock, Dollar Tree, another good one, Dollar General, exactly. Most of the people that are shopping in those stores are probably not the stockholders of those companies. Unlike Apple, a lot of people that buy expensive Apple stuff probably own Apple stock as well too. So if you can, and that's another network effect, right? I own the stock, I buy the product, I tell everybody how great my Tesla car is, and the stock goes up, and I feel doubly good. I think I got a cool car, and I got a cool investment as well too. Well, the Dollar Generals and the McDonald's, they would love to have that too. Go out and tell everybody how great that McDonald's burger was, and when they go in and buy a burger, your token goes up in value as well. So you could maybe bring those two groups, your owners and your customers, and merge them as one group. Things that we haven't been able to do in the current financial system. And a lot of old line companies could really, really benefit from that.
Jim, when we look back on this video in 5 years, what are you most confident in that you'll be able to point to and be like, aha, see, I told you? What are you most confident that you talked about today, that you're certain in 5 years you can look back in this video and be like, ha, got that one right?
Well, that's still alive. Let's start with that one. But seriously, that DeFi is a thing. That decentralized finance will still be around in 5 years. Maybe every one of the coins I've mentioned in Uniswap and Doge and Ethereum, maybe some of those are not around. And there's some new coins that don't exist today that will be there in 5 years.
Yeah,
I think that I feel we'll be very confident. And in 5 years, I think a lot of people will understand that it's the next level of finance. And let me throw out an idea that I don't know if we'll do it in 5 years, but maybe close. Currently, because of technology, you've got this unusual situation where the largest taxi cab company in the world, Uber, doesn't own any taxi cabs. the largest hotelier in the world, Airbnb, doesn't own any hotels. I think the next largest bank of the world is not going to be handing out loans. It's going to be a DeFi protocol that's going to be this meeting of buyers, and it's going to be the meeting of lenders and borrowers. It's going to be a protocol for them to meet, but it doesn't hand out loans. But it'll be generally like Airbnb and Uber, recognized as the largest bank in the world. That might happen in
interesting,
5 years.
yeah.
Or if it doesn't happen in 5 years, it'll be a lot clearer that that's the road we're going down.
Wow, that's a really interesting concept. I mean, listen, I don't claim to be an expert in this, but conceptually, it makes perfect sense to me, 100%. So one last question for you before I let you run. I want you to know how much I appreciate this. This is awesome. This is so cool for me. So we talked about traders. What can traders do? It's obvious. You can trade these things. Investors want to look longer term. They can do that too. Check, check. Great. What about financial advisors? What would you tell financial advisors? We have a huge audience of advisors that listen to this podcast, that I'm friends with, that are wondering, great, JC, this is fantastic. But other than maybe, messing around for the PA, what am I supposed to tell my clients when they come asking? Like, how do I prepare them for this? What do you tell advisors?
Learn this stuff. Learn this stuff because this is the future of finance. And what you can do for your clients is you could maybe even be a resource for them if they want to play in this space, or if they don't want to play in this space, you can be prepared to guide them when the tools come into play for you. So if you spend the time, like I said, you can't take a 3-day course on cryptocurrencies and be done with it any more than you could have took a 3-day course as an undergrad in what is the stock market and say, good, now send your resume to Goldman Sachs.
Right.
So start to learn this stuff, because when these new tools, when a Bitcoin ETF comes or an Ethereum ETF comes, or more companies start to adopt this stuff, and your clients say, I want to learn more about this, I want to try and invest in this, you're ready, because it's only going to get bigger. It's not going to get smaller. It's going to get more important. It's not going to get less important as we move forward, especially if you look at the decentralized financial world. And I also think that's why I started with DeFi. And, it's fun to talk about Dogecoin going from a penny to 60 cents in less than 5 months. Gets all the headlines. But the real meat and potatoes of this stuff is this parallel financial system. There's going to be room for advisors in that parallel financial system.
Has to be, right?
There has to be. And there will be plenty of room. But you know what there's not going to be room for? Advisors that don't know this stuff. The advisors that are winging it. It's not going to be easy. You're going to go. I think the best source on this stuff is YouTube, because there's a lot of people on YouTube, like that crypto dad guy, that actually.
Dude, YouTube for everything. I'm building stuff for the baby,
oh yeah,
chairs and all sorts of stuff. The instructions are like unusable. You just go to YouTube, get this stuff done. So this is no different.
Yeah, it's funny because I did the same thing last week. I had to fix my bicycle. I said to my wife, I'm going to go fix my bicycle. And I said, I got to get my 2 things. I got to get my tool bag and I got to get my iPad, because I'm just going to go out in the garage and I'm going to type into YouTube what I want to fix on the bike. And I'm just going to watch the video as I'm doing it. And that's essentially what you're going to do here too.
Yep.
You're going to go to YouTube and you're going to watch the video as you learn how to do this stuff. And you know what? It is hard. It is hard, but that is a very, as you know, like.
Is it that hard though? Is it that hard, Jim?
Only if you're not computer literate, but it really isn't as hard. It is scary because if you make a mistake, you can lose your money. If you make a mistake, there is no customer service to call in this space. You're on your own in that respect. So a lot of times what they'll tell you is, if you have $500, the first thing you do with your Metamask wallet is you transfer $10. And it might cost you $10 in fees, but don't worry about the fees because it's all very volatile. Transfer 10. Okay, it made it in there. Then you could send the other 490 exactly the same way. Because if you send 10 and it disappears, be lucky you didn't send all of it, is what you've got to do. Once you've
dip your toe first and then jump in.
Yeah, exactly. Because there is no undoing it.
Right.
There is no undoing it. Once you've done it a bunch of times, like I've done it 100 times, sending money or doing trades, I know I'll do the whole thing straight up because I've got some experience. I know the pitfalls. I know where you make a mistake that you can lose your money, so I know not to do it.
Right.
Once you've learned that, then you feel more confident about it. But yeah, for the advisor community, you're getting a whole new set of tools is what you're going to get. And as I said, what was the big problem with the current set of tools? Well, the S&P's up 12, and the funds that do well are up 13, and the funds that do poorly are up 11. Why do we bother? Well, with this stuff, it could be the S&P's up 12, but the tokens that do well are up 500, and the tokens that do poorly are down 90%. And somebody who knows this token stuff could really add a shitload of value to me or to my customers as well too, as opposed to helping me gain 1% extra over the S&P. And so, yeah, that's why I think I'd be excited if I was an advisor, because it's going to give me more stuff to play with, not less. But the problem is, can't learn it in an afternoon. You got it, and that's why it's not ready now. So spend a little bit of time now, every day or every week to just try and come along so that when it's there, the product is there. I know what it is. I know what to do with it. As opposed to what is this thing and what am I supposed to do with it?
How do you spell Doge?
Exactly.
Jim, listen, man, this was awesome. We're definitely going to do this again. So I hope you come back. I want to continue this conversation. This is fantastic. Absolutely great. We didn't even talk about, S&Ps or 10-year. I would have taken the over on that, but this is great. Dude, this is awesome. Thank you.
I would have taken the over on it too. And the answer is up on both S&Ps and interest rates.
Love it. All right, Jim.
That's our show. Thanks again for listening. To learn more about how JC and the team are taking advantage of this DeFi revolution, along with some of their favorite trades, please visit allstarcharts.com. See you next time.